All right, welcome back to our chronological deep dive into the Ambani story. We're picking up exactly where we left off, dropping right into the shifting political winds of 1980. We're looking at a period where Dhirubhai Ambani didn't just grow a company. No, he fundamentally rewired how business was funded in India. He literally sparked a revolution.
To really grasp what he achieved, we have to look at the landscape of the time. Picture this. India was operating under what was known as the License Raj, a highly restricted, incredibly bureaucratic economy. And because of some brutal historical busts, the general public deeply distrusted the share market. So where did the money come from? Well, the major business houses of India relied heavily on government-owned banks and financial institutions for their funding. It was slow, it was restrictive, and it kept all the power concentrated right in the hands of the establishment. But you know what? That was all about to change.
The real political turning point hits in 1980. Indira Gandhi returns to power as prime minister. And for Reliance, this comeback was absolutely critical. You see, Dhirubhai had meticulously cultivated relationships with Indira and other key Congress party figures during their time out of power. So with sympathetic ears now back in New Delhi, the regulatory roadblocks started to clear. This meant Reliance's rapid and often controversial expansion could truly kick into high gear. Okay. Let's dive into this. To bypass those slow, restrictive banks, Dhirubhai decided to utilize equity. Simply put, equity is the value of the shares issued by a company. When you buy it, you're buying a tiny piece of ownership. Think about why this matters. Instead of bowing to a bank's intense scrutiny and their demands for control, Dhirubhai realized something brilliant. He could bypass the middlemen and sell pieces of his vision directly to the Indian middle class.
And he prepared for this moment masterfully. Back in 1975, he executed this clever restructuring. He floated a tiny company called Mainland LD, which was then amalgamated to take over the massive assets of Reliance. It was a maneuver that was widely studied later for its absolute tax minimization brilliance. By 1977, the name was changed back to Reliance Textile Industries, and it officially listed on the Bombay and Ahmedabad exchanges by early 1978. He now had the perfect vehicle to raise massive public capital.
And he needed that capital for a very specific reason. Fast forward to October 1980, and Reliance completely shocked the Indian business establishment. The government issued 3 highly coveted licenses for the manufacture of polyester filament yarn in a so-called backward area called Patalganga. Reliance won the largest license by far. They got permission to produce a staggering 10,000 tons a year. To put that into perspective, at the time, that was close to India's entire existing polyester fiber output. What makes this victory so incredible is who Reliance actually defeated. There were 42 other contestants, including giant, multi-generational business families like the Birlas. But the rapidly growing upstart won. Dhirubhai's unmatched ability to navigate the corridors of power in New Delhi had secured him the golden ticket. It was the exact ticket he needed to transform Reliance from a textile weaver into a massive industrial giant.
But winning the license was just step one. Dhirubhai and his eldest son, Mukesh Ambani, traveled to the United States to secure a groundbreaking technology deal with the American chemicals giant DuPont. This $26.7 million order allowed Reliance to build a highly complex petrochemical plant. This was what we call backward integration. So instead of buying yarn to weave into fabric, Reliance would now manufacture the raw polyester yarn itself, capturing the profits at literally every single step of the chain.
So how do you fund a massive project like Patalganga? Dhirubhai utilized a financial instrument that would become his absolute signature weapon, the convertible debenture. Think of it as a hybrid. Initially, it's a loan you give to the company, and they pay you regular interest. But after a set period, that loan converts into equity shares. This instrument was actually being revived by an energetic government bureaucrat named Nitish Gupta, who really wanted to revitalize India's sleepy capital markets. And Dhirubhai recognized it as the ultimate tool for expansion.
The contrast between the two funding methods here is crucial. If you take a traditional bank loan, state financial institutions demand board seats. They can even convert their debt into equity to literally take control of your company. Debentures bypass this entirely. They were fast, they were funded directly by the public, and most importantly, they ensured Dhirubhai retained absolute control over his empire.
Reliance issued these debentures in rapid succession, Series I through IV, raising hundreds of millions of rupees. But then, Dhirubhai executed a brilliantly unconventional trick. These were partially convertible debentures, meaning a portion of them was meant to stay as permanent debt. Dhirubhai went to Nitish Gupta and requested the impossible.
He asked for permission to convert the non-convertible portions into equity as well, and remarkably, he got the clearance.
And this brilliantly illustrates the staggering financial shift that followed. By converting that debt into equity in 1983, Reliance wiped 735 million rupees of debt off its books practically overnight, replacing it with just 103 million in equity. The massive interest payments just vanished, instantly boosting their profitability. Meanwhile, investors were absolutely thrilled to receive highly valuable Reliance shares instead of a boring fixed-interest bond. It was an incredible win-win that kept the growth engine roaring.
Furthermore, Dhirubhai constantly rewarded his investors with rights and bonus issues. If you held Reliance shares, the company would regularly offer you the right to buy more shares at a steep discount, or, even better, simply give you additional shares entirely for free. This built a fierce, almost fanatical loyalty among his investors. They weren't just funding a company anymore. They were riding a wave of rapidly appreciating wealth right alongside him.
This success represented a really unique collision between two worlds. You had the bustling, shouting chaos of Dalal Street, the home of the Bombay Stock Exchange, smashing right into the bureaucratic corridors of New Delhi. Dhirubhai's stock market dominance was greatly aided by highly favorable policies from his friends in high places, particularly the influential finance minister, Pranab Mukherjee. And this political backing? It gave market operators immense confidence in Reliance's invincibility.
But, of course, that invincibility would be tested. The Bombay Stock Exchange in 1982 was a frenetic, wild place. It largely operated on a traditional system called Badla trading. Badla allowed traders to buy or sell shares without actually taking immediate delivery of them. They could basically carry forward their transactions to the next settlement period just by paying a fee. It was a highly speculative system, allowing traders to make massive bets with very little upfront cash. Now, you might be wondering, how does this affect Reliance? Well, this speculative environment set the stage for a massive confrontation. In March 1982, a powerful cartel of bear operators, reputed to be based in Calcutta, decided Reliance shares were overvalued. They launched a brutal attack. They aggressively short-sold Reliance shares, meaning they were selling shares they didn't actually own, hoping to crash the price and then buy them back cheaper later. Their goal was simple. They wanted to break Dhirubhai.
But Dhirubhai fought back spectacularly. As the bears dumped shares, mysterious non-resident Indian, or NRI, companies registered in the UK started buying everything. We're talking companies with bizarre names like Crocodile and Fiasco Investments. By settlement day in April, the bears had a huge problem. They had to deliver shares they didn't have. Caught in a brutal short squeeze, the cartels suffered crushing financial losses. Now, it definitely must be noted that critics in the media heavily alleged these NRI funds were actually Dhirubhai's own offshore money returning to India. It was a suspicion that sparked intense controversy. While all these wild financial battles raged, the physical reality of Reliance was taking shape at breathtaking speed. Construction at Patalganga began in April 1981. By November 1982, it was in regular production. This massive, highly complex petrochemical plant was built in a record 18 months, and the project was managed by a 24-year-old Mukesh Ambani, who had just returned from Stanford. Even DuPont executives admitted it would have taken 26 months to build a similar plant in the United States.
And the political timing was, well, impeccable. Just 3 weeks after Patalganga opened, the government applied a massive anti-dumping duty of 15,000 rupees a ton on imported polyester yarn. This effectively locked out foreign competition and allowed Reliance to raise its prices domestically, virtually guaranteeing immense profitability. Naturally, critics pointed to this as proof that Reliance was manipulating government policy to crush its competitors.
Armed with this protection, the Reliance machine just roared into 1984. Patalganga immediately began operating well beyond its officially licensed capacity, a fact the government later retrospectively legalized. The company also employed aggressive, zero-tax accounting strategies, heavily utilizing depreciation, and frequently changed its accounting year to smooth out bad patches. All of these maneuvers kept profits looking absolutely stellar, paving the way for the massive Series E and F debenture issues, which raised billions more from the public. By 1985, Dhirubhai's popularity had reached an absolute fever pitch. At the company's annual general meeting that year, an unprecedented 12,000 shareholders showed up. There literally wasn't a hall in Bombay big enough to fit them all. The meeting had to be held outdoors in the Cooperage football grounds under massive canvas awnings, with shareholders watching the directors on television monitors. It was a spectacle of corporate devotion entirely unseen in Indian history. Yet,
Right alongside this adulation was fierce criticism. Journalists like S. Gurumurthy argued impartially that Dhirubhai was exploiting the system. Gurumurthy wrote about how Reliance thrived on exceptions and sub-rules, like converting that non-convertible debt we talked about. He argued that this systematic manipulation of bureaucrats and regulations was subversive and ultimately threatened to destroy the main rule of law governing Indian business.
But to the millions of middle-class investors who held Reliance paper, none of that mattered. Dhirubhai spoke to them directly, famously calling them his family. And they believed him. Why? Because unlike the old aristocratic business houses, Dhirubhai bypassed the gatekeepers. He delivered unprecedented, tangible wealth directly into the pockets of the ordinary Indian citizen. To them, he wasn't a manipulator, he was a financial visionary.
Reflecting this immense scale and the transition far beyond just weaving cloth, the company officially dropped textile from its name in 1985. It became Reliance Industries Limited. It was no longer just a mill. It was a sprawling, vertically integrated petrochemical powerhouse funded by the largest shareholder base in the entire country.
So what does this all mean? We are left with a fascinating paradox. How did an outsider from a small village learn to pull the levers of New Delhi's bureaucracy and Bombay's stock exchanges so masterfully? Viewed by critics as a dangerous anti-hero who bent the state to his will, yet crowned by over 1 million loyal investors as the guru of the equity cult. It's a legacy of immense power, and it perfectly sets the stage for even darker, higher-stakes battles to come. We'll explore those in our next explainer.